This is the strategic deconstruction of Yuding Additive Manufacturing, a business that behaves like a national laboratory wearing a corporate suit. On paper, it is a high-tech pioneer prepping for a landmark listing. In reality, it is a financially fragile military contractor operating with a massive policy cushion. This prospectus contains a striking contrast between absolute technological dominance in military aerospace and a severe cash collection drag. We'll analyzing how a business with a 500-day accounts receivable backlog and an 80% customer concentration plans to survive its own post-IPO asset expansion. This is an objective look at the metallurgical moats, regulatory bottlenecks, and the structural debt burdens of a critical defense payer. Yuding sits on a powerful technological monopoly. It is the sole supplier for massive load-bearing structures on China's frontline military aircraft. However, this technical moat hides a precarious capital structure. The reported $9.86 million net profit in 2025 is largely an accounting mirage engineered by $8.92 million in government subsidies. Core operations are barely breaking even, scraping by on a tiny margin of under 3%. Meanwhile, working capital is permanently trapped in defense procurement audit backlogs. The upcoming $250 million IPO is designed to aggressively multiply their physical capacity, but it simultaneously triggers a massive depreciation cliff that could erase their entire profitability if downstream demand hesitates. The corporate history of Yuding is a story of low-cost academic technology transfer. The company is the commercial vehicle for Beihang University's National Engineering Laboratory. They inherited a decade of taxpayer-funded state research, bypassing the traditional cash-burning R&D phase that kills most tech startups. When the academic founders utilized China's leave of absence entrepreneurship policy in 2021, they directly embedded their university laboratory discoveries into active aerospace supply chains. While this academic pedigree guarantees world-class metallurgy, it has also created a corporate culture that historically neglected commercial marketing. They operate as a captive government workshop, which works fine until you have to convince public equity markets of your commercial agility. Yuding has built a decentralized geographic layout that separates research from physical manufacturing. The corporate headquarters and advanced labs are registered in the Xiong'an area, a move driven by aggressive municipal relocation and talent subsidies totaling millions of dollars. Meanwhile, the actual heavy manufacturing is located in Chengdu, close to major military assembly hubs. This geographic separation secures short-term financial grants, but introduces permanent logistical friction. Crucially, the revenue footprint is entirely domestic. There is exactly 0% global market exposure. This mainland-locked status protects them from foreign geopolitical interference, but entirely caps their growth potential within domestic defense allocation boundaries. We are transitioning to the competitive landscape of industrial metal additive manufacturing. To understand Yuding's positioning, we must strip away the broad market hype. The metal 3D printing market is a story of two worlds. The broad commercial sector is increasingly commoditized, with multiple suppliers eroding margins on standard powder bed fusion systems. Yuding ignores this space completely. By focusing exclusively on military-grade large structures, they have captured a highly protected, non-cyclical niche. Their metal additive revenue was $37.67 million in 2025, which looks tiny on a global scale, but represents a virtual monopoly for specific structural aviation joints. They do not need to fight for market share because the barrier to entry is so high that competitors can't even bid on their core programs. It is a highly secure, yet highly restricted territory. When we compare Yuding to domestic peers like BLT and Farson, the strategic trade-offs become clear. Peers have diversified into medical, automotive, and consumer electronics to cushion themselves against procurement shifts. Yuding is almost entirely dependent on defense budgets, with over 90% of sales tied to military programs. This specialized focus explains their lower gross margin of 28.48% compared to BLT's 42%. Yuding carries the high overhead of a custom military supplier without the benefit of standardized high-margin commercial printer sales. They are highly insulated from commercial competition, but completely vulnerable to changes in state procurement tempos. The industrial metal printing landscape is split between two primary technology routes. Directed energy deposition, or DED, is Yuding's core strength. It uses lasers to melt metal powder as it is sprayed, allowing them to build massive structures without the limits of a sealed chamber. The alternative is powder bed fusion, or PBF, which is the industry standard for small, highly precise internal geometries. DED is fast and unconstrained, but it produces a coarse surface finish that requires extensive post-print CNC machining. Yuding has historically owned the heavy structural segment, but they are now investing heavily in PBF to capture the precision market, attempting to master both ends of the manufacturing spectrum. Yuding's absolute moat is their ability to control thermal stress in ultra-large titanium components. Printing a 10-meter aircraft frame joint is a metallurgical nightmare because the rapid heating and cooling cycles of the laser can warp or crack the metal. Yuding's proprietary algorithms and custom DED scan paths solve this bottleneck, maintaining structural integrity equivalent to massive traditional forgings. This technology drops the material buy-to-fly ratio by over 70%, saving millions in titanium powder waste. However, because a single internal microscopic void could cause a fighter jet wing to fail mid-flight, they are forced to run slow, expensive non-destructive testing, which caps their maximum delivery throughput. The push into powder bed fusion is not just an R&D project. It is a strategic move to enter the nuclear energy supply chain and reduce their reliance on military aviation. By using the precision of PBF, Yuding is printing heat exchangers for fourth-generation fast reactors. These components require tens of thousands of microscopic channels that cannot be manufactured with traditional subtractive CNC milling. While this nuclear pivot opens up a multi-billion-dollar utility replacement cycle, it is blocked by severe regulatory hurdles. The qualification process with the National Nuclear Safety Administration can take up to 4 years, meaning this new business curve will not generate real cash flow anytime soon. We're moving into the business model and the hidden vulnerabilities of Yuding's supply chain. Yuding's commercial model is built on an integrated manufacturing loop. They do not sell their proprietary 3D printing equipment, nor do they sell raw metal powders. Instead, they retain their self-manufactured machines for internal processing capacity. They print the rough billet, then utilize their wholly owned subsidiary Puracy to machine and finish the parts using 5-axis CNC centers. This vertical integration keeps their capital equipment costs relatively low and prevents proprietary military design geometries from leaking to external subcontractors. It is an effective, highly secure closed loop that protects their IP, but it limits their business to a low-volume, specialized service provider model rather than a scalable hardware vendor. Main business revenue has plateaued at $53.63 million in 2025, showing a slight contraction from previous years. This flatline is a classic signal of the transitional phase in China's 14th five-year defense procurement cycle. Metal additive products remain the dominant driver, contributing 64% of the top line. Meanwhile, the CNC equipment division has climbed to nearly 29%, acting as a stable secondary source of income. The tech services segment saw an artificial jump, but the overall picture is a company waiting for next-generation defense programs to enter batch production. They are built for scale, but currently operating in a holding pattern. The CNC division operates as a commercial hedge against military volatility. Capacity has remained fixed at 200 units per year, but the operational metrics show a dramatic shift in inventory management. In 2024, Yuding overproduced, pushing capacity utilization to 123%, which resulted in a massive inventory pileup. In 2025, management cut back production and successfully cleared that stock, bringing the sales-to-production ratio to a healthy 116%. However, because these machines require extensive custom tool configurations for civilian automotive clients, the division can't easily scale its margins, leaving it vulnerable to pricing pressure in a highly competitive domestic machine tool market. The customer concentration metrics are highly concerning for any investor accustomed to commercial business models. Over 82% of Yuding's revenue is controlled by their top 5 clients. Even more striking is their reliance on a single military aviation conglomerate, designated as Unit A, which alone contributes over 60% of total revenue. This is a monopsony reality. Yuding has no alternative buyer for its large-scale structural titanium components. If Unit A decides to adjust its procurement schedules, change its design specifications, or implement a dual sourcing strategy to cultivate backup suppliers, Yuding's core revenue line is instantly threatened. They are completely tethered to one customer's administrative decisions. While Yuding secures its raw titanium alloy powders from stable domestic suppliers like Baiji Titanium, its hardware remains vulnerable to foreign export rules. The core components of their 3D printers, including high-power lasers and optical scanners, are heavily imported. More critical is their CNC division's dependence on Japanese control systems. They purchased over $3.6 million in CNC controller modules directly from Fanuc in 2025. This is a severe technological bottleneck. If geopolitical tensions trigger strict trade embargoes, Yuding's ability to assemble machine tools and finish printed structures would be paralyzed. They are trying to develop domestic alternatives, but accuracy variances remain a persistent issue. We are examining Yuding's intellectual property and its active R&D pipeline. Yuding's intellectual property portfolio is highly independent. They hold 109 authorized patents, with over 74% categorized as invention patents. This indicates a very high technological density compared to simple utility models. Crucially, they have 0 co-owned patents. Every single patent is 100% owned by Yuding or its subsidiaries, eliminating the risk of academic institutions clawing back technology rights post-listing. The 20 patents they acquired from Beihang University and Purusi have been fully integrated, providing clean legal protection for their core DED printing and CNC finishing operations. It is a clean, defensible technology shield. The legal separation from Beihang University is complete on paper, but operational linkages remain deeply connected. Beihang has issued formal certificates disclaiming any ownership over the founders' technology, confirming that their startup projects do not constitute service inventions of the university. This is a vital regulatory hurdle cleared for the IPO. However, Yuding's talent acquisition pipeline remains heavily dependent on Beihang graduate programs and postdoctoral research stations. Shifting their core R&D operations to the new Chang'an facility is an expensive but necessary move to establish a distinct corporate identity, reducing their structural dependence on the academic lab's networks and facilities. The current R&D pipeline reveals a strategic shift toward cost reduction and material expansion. They're investing $1.34 million into low-cost titanium composite manufacturing, aiming to reduce powder waste by 30% to protect margins against strict military cost audits. Another key project is the stress control of superalloys like GH3230, which is their gateway into next-generation jet engine manifolds. They are also pushing the physical boundaries of DED, attempting to achieve 7-meter single-step component printing. This research is vital to consolidate their monopoly on structural joints, but it consumes millions of dollars in testing materials with 0 guarantee of immediate commercial adoption. Yuding is actively researching high-performance copper alloys for marine ship propulsion, specifically propeller hubs designed to withstand extreme seawater cavitation. This project, budgeted at $2.79 million, is a direct attempt to diversify away from volatile aviation budgets and build a relationship with China State Shipbuilding Corporation. If successful, Yuding applies its large-scale additive manufacturing expertise to marine engineering. However, the naval sector operates under its own intense quality standards and budget constraints, meaning Yuding will face experienced traditional forging competitors who are highly protective of their historical market shares. We are entering the deconstruction of Yuding's financial quality. Yuding's top-line revenue has stalled at $54.61 million, while its overall gross margin has compressed by 676 basis points, down to 28.48% in 2025. This margin erosion was driven by a steep 10 percentage point drop in their core metal additive products segment, following the high setup and depreciation costs of the new Chang'an base. They also delivered a higher mix of newer, unoptimized components with lower production yields. While they employ a highly conservative accounting policy of expensing 100% of their R&D outlays immediately, this practice puts severe near-term pressure on their reported operating profits. The reported net profit of $9.86 million in 2025 is a financial illusion. Over $11 million flowed into the pre-tax profit line from government subsidies and tax benefits. This means Yuding's policy dependency ratio is over 111% of its reported earnings. The core business operations are effectively running at a loss, kept afloat by non-operating Shawan relocation grants and preferential high-tech tax rates. This is a critical risk. If these regional subsidies taper off, or if their tax preferences are challenged during future audits, the optical profitability of this business will evaporate, exposing a razor-thin organic operating margin. Stripping away non-recurring subsidies reveals the true organic profitability of the core business. In 2024, Yuding actually suffered an organic operational net loss of over $500,000. In 2025, they recovered to a meager core net profit of $1.49 million, which represents a thin 2.73% core margin. This core earnings line is incredibly fragile. It shows that the entire company operates on the edge of profitability, highly vulnerable to minor fluctuations in raw titanium powder costs or slight delays in defense order delivery. It is a low-margin, capital-intensive manufacturing business disguised as a highly profitable tech pioneer. The balance sheet is under a severe liquidity chokehold. Their accounts receivable turnover days exploded to 500 days in 2025. This deterioration is driven by Product A, a critical component delivered for a major transport aircraft. Because the military is conducting a prolonged design review, final pricing audits are suspended. Yuding is forced to continue manufacturing and delivering parts without receiving cash settlements, locking up $53.63 million in unbilled contract assets. Consequently, Yuding has had to write down over $7 million in aging impairments, creating a massive cash drag that severely impacts their operational liquidity. Related party transactions with Beihang University have dropped from 9% of revenue to under 3%, showing progress toward corporate independence. However, a major anomaly distorted their 2025 earnings. A retroactive price adjustment of $1.29 million from Beihang flowed directly into Yidong's technical services gross margin, pushing it to an absurd 85%. Because the manufacturing costs for these parts were recognized in previous years, this related party adjustment acted as a clean windfall with zero offsetting costs. It was a convenient earnings cushion that artificially propped up their 2025 gross profit right when they were filing for the IPO. The cash flow statement confirms that Yuding cannot organically fund its own operations. Cumulative free cash flow over the last 3 years is negative $33.97 million. In 2024, their cash received relative to revenue plummeted to 54%, triggering a severe operating cash burn of over $13 million. They survived this liquidity crisis solely because of a massive $117 million Series B equity injection in late 2025. Without this capital lifeline, the military receivables chokehold would have triggered a technical default. They are entirely dependent on venture capital to keep their factory doors open. We are deconstructing Yuding's corporate governance and capital structure. Yuding's executive board is heavily academic, dominated by Beihang University PhDs and researchers. Dr. Liu Dong and Dr. He Bei hold deep technical expertise, but have relatively limited experience managing large-scale commercial manufacturing operations. Direct cash compensation is modest, with the entire executive team receiving under $700,000, but this is offset by heavy stock option grants. The addition of industrial veterans like Yin Haifeng to manage the nuclear expansion is a step in the right direction, but the leadership bench remains light on the financial and commercial capabilities required to run a complex public company. The actual controller, academician Wang Huaming, faces a severe dilution of voting rights. Post-IPO, his voting block will fall to just 19.12%, exercised indirectly through Baoshang Technology. This is well below the traditional 33% threshold required to block hostile shareholder resolutions. Yuding has no dual-class share structures or special voting rights in place. leaving the company structurally vulnerable to external takeover attempts. While their sensitive military patents might trigger state protection, the low shareholding ratio remains a significant governance risk that could lead to leadership instability and strategic disruption post-listing. The rush of 34 new financial investors entering the equity structure in the 12 months preceding the IPO is a massive red flag. These late-stage PE and VC funds injected over $140 million, shoring up Yuding's depleted cash reserves, but acquiring over 28% of the pre-IPO shares. This concentrated onboarding created a massive capital overhang. Once the 12-month post-listing lockup period expires, the pressure on these financial investors to exit and realize returns will be immense. This represents a heavy, continuous threat of downward pressure on Yuding's share price. The historical performance-linked stock options reveal a high-pressure corporate environment. Out of 4 option tranches, the company completely missed its revenue targets in 2022 and 2024, forcing management to cancel and void those tranches. They only cleared the revenue hurdles in 2023 and 2025. While all historical valuation adjustment mechanisms and priority liquidation rights have been officially terminated pre-IPO for compliance, the pattern of missed growth projections shows that the founding academic team has historically struggled to meet the aggressive financial expectations set by their institutional backers. We are analyzing Yuding's proposed IPO fundraising allocations and the looming financial load of their capacity expansion. The $250 million capital ask is entirely focused on heavy assets and R&D. Over 88% of the proceeds are allocated directly to physical expansions, including $61 million for aerospace DED lines, $55 million for nuclear PBF facilities, and $50 million for ultra-large printing systems. Notably, there is exactly zero allocation for commercial marketing or sales networks. This confirms Yuding's strategic lock-in as a captive military subcontractor. They are betting entirely on build capacity and technology, allocating only 11% to replenish the working capital currently being consumed by their 500-day receivable cycle. Yuding's planned equipment purchase represents an extraordinary 293% jump over their existing machinery gross value. They are virtually rebuilding their entire hardware footprint from scratch, attempting to scale their productive assets by 4 times. This is an incredibly aggressive capital expansion. While it is designed to capture the anticipated demand of the next defense procurement cycle, it introduces massive execution risks. It takes up to 36 months to install, calibrate, and qualify these ultra-large machines, meaning the company will carry the cost of this massive expansion long before it generates a single dollar of revenue. The 4-fold capacity surge faces significant regulatory and market barriers. The newly built PBF nuclear line requires multi-year certifications from the National Nuclear Security Administration, an agency notorious for its slow-moving, rigorous audits. If certification is delayed, the new equipment will sit idle. Meanwhile, the DED aerospace expansion depends entirely on maintaining their sole supplier status with Unit A. If the military's dual sourcing directives successfully introduce a backup supplier, Yuding will find itself with a massive surplus of expensive, specialized machinery that cannot be repurposed for the civilian market. The newly activated assets will generate an estimated $10.25 million in annual depreciation charges, calculating machinery at a 10-year rate and buildings at 30 years. This annual fixed cost exceeds Yuding's entire reported net profit of $9.86 million in 2025. If revenue remains flat post-IPO, this depreciation load will instantly wipe out their operating profit, pushing the company into a net loss and compressing gross margins to under 10%. To survive this depreciation cliff, Yuding must achieve immediate, synchronized top-line revenue growth of at least 40% in year 3. We're entering our final section, deconstructing Yuding's strategic risk heat map and establishing our concluding investment remarks. The highest immediate threat to Yuding's balance sheet is the risk of retroactive downward pricing revisions. Currently, over 36% of their 2025 revenue is recognized based on provisional pricing. These temporary rates are subject to final audits by military cost control departments, which hold absolute bargaining power. If the final audited price for product A or other components is revised downward, Yuding has no legal recourse. They will be forced to immediately write down their revenue and contract assets retroactively. This would directly slash their current period net profits with zero associated manufacturing cost offsets. The second major risk is the military's structural shift toward dual sourcing. National security directives increasingly require prime contractors to establish backup suppliers for critical components to eliminate single-source dependencies. Competitors like BLT and traditional high-end forging giants are actively pitching Unit A to enter Yuding's structural printing pipeline. If a backup supplier is qualified, Yuding loses its sole source monopoly status. This would severely erode their future pricing power and unit volume share, forcing them into price competition and leaving their newly expanded IPO capacity dangerously underutilized. Yuding Advanced Materials is a technologically elite yet financially fragile asset. Their world-class DED capabilities secure a critical position in national security manufacturing, but their earnings quality is heavily distorted by related party transactions and government subsidies. The impending depreciation cliff and the 500-day accounts receivable cycle present severe liquidity risks. This is a business best suited for institutional capital, with long investment horizons and high political awareness. The key to their long-term survival is whether they can successfully diversify into nuclear and marine sectors, reducing their customer dependency on Unit A under 50%. That is the hard, cold reality behind the Yuding IPO. It's an engineering marvel wrapped in a financial puzzle that would make even a seasoned analyst reach for a drink. If you have questions about these numbers, or if you want the full high-density deck with all the financial breakdown tables, send a message to sales@hdinresearch.com or click the link in the description. Don't forget to follow @HDIN230 for more analysis that actually cuts through the hype.